Welcome to the debate. This is breaking news to trading moves. If you were building a suspension bridge, you would demand endless redundant cables, a backup for your backup.
Right, because if one steel cable snaps, the bridge still holds.
Exactly. It's basic engineering, and honestly, it is how most of us approach risk in our daily lives. I mean, we buy insurance policies, we keep spare tires in our trunks.
Yeah, we like things to have fallback plans. Mathematical safety. You don't put all your structural integrity into a single pillar because, well, the world is inherently unpredictable.
But when you step into the world of wealth creation and portfolio construction, the greatest minds in financial history tell us that safety nets are actually traps. We are looking at an investment landscape where extreme, almost uncomfortable concentration is championed.
It is. I mean, Charlie Munger famously asserted that diversification is a rule for those who don't know anything.
Right. His own family concentrated their wealth in essentially just 3 assets.
Which is the absolute definition of playing without a net. It terrifies most people, and frankly, it should.
So today we're debating that exact tension. We are looking at the conflict between hyper-concentration and broad diversification. On one side, you have Munger's doctrine of knowing everything about a few things.
And on the other side, you have modern portfolio theory. John Bogle's timeless doctrine for standard investors. Buy the entire haystack, dollar cost average, and just wait.
Exactly. So the central question is, are concentrated high-conviction portfolios the optimal strategy for market outperformance?
Or is that just a fast track to capital destruction for the vast majority of market participants?
Well, I argue that concentrated, high-conviction portfolios, when paired with extreme patience and rigorous analysis, are the absolute best mechanism for wealth creation. True wealth is built through relentless focus, not broad, diluted exposure.
And I come at it from a completely different way. I argue that forced concentration routinely damages performance. The reality is that diversification remains the mathematical and practical imperative for anyone without a profound verified informational edge. Concentration often leads directly to permanent financial ruin.
Let's get into the mechanics of focus then. Because wealth isn't built by owning a tiny slice of 500 average companies.
But it is protected that way.
Protected maybe, but not built. Munger's philosophy was never about blindly throwing darts at a single stock and hoping it goes up. It is about finding the absolute best business models in the world and, having the unwavering confidence to hold them through incredible volatility.
Okay, but how many people can actually do that?
Well, look at the Nomad Investment Partnership, run by Nick Sleep and Kaisa Correa. They routinely concentrated 70 to 80% of their capital in just 10 businesses.
10?
Just 10. We are talking about companies like Amazon, Costco, Berkshire Hathaway, and they held these businesses for an average of 5 years.
Which is an eternity in modern finance.
It is. But this combination of intense conviction and strict inactivity generates alpha. And let's define alpha clearly here. It is the excess return you earn above the market benchmark.
Right, so if the market returns 8% and you return 12%, that 4% difference is your alpha.
Exactly. It is the holy grail of investing. But here is the mathematical reality. You cannot generate alpha if you own the entire benchmark. If you spread your bets too thin across 50 or 100 stocks, you mathematically guarantee that your best ideas are diluted by your mediocre ones.
Dragging you right back down to average.
Yes, it is inevitable.
Well, you are pointing to an anomaly of extreme privilege and informational advantage there. What works for Charlie Munger or the Nomad Investment Partnership is incredibly dangerous to extrapolate to the broader market.
Why is it dangerous if the principles are sound?
Because of how it's executed. The Jaina investment analysis demonstrates this perfectly. They looked at what happens when active equity managers attempt to run high-conviction portfolios.
And what did they find?
The data shows that merely increasing the active weight, meaning the percentage of the portfolio that intentionally differs from the benchmark index, it routinely leads to lower performance. It literally backfires.
Lower performance from higher conviction?
Yes. Furthermore, retail investors, and honestly most professional managers, they just do not have the time, the resources, or the accounting background to analyze thousands of 10Ks.
Well, reading 10Ks is grueling work, I'll give you that.
A 10K isn't just a glossy annual report. It is a 100-page, dense financial document. You have to comb through the management discussion and analysis, scrutinize the risk factors, verify debt covenants.
Right.
So for the normal participant, John Bogle's principles and modern portfolio theory are the only mathematical shields against the ruin of picking the wrong concentrated bets. Bogle's genius was realizing that an index, like the S&P 500, is naturally self-cleansing.
Self-cleansing because the losers drop out.
Exactly. The losers drop out, the winners grow to dominate the index, and you get to capture that upward drift without ever reading a single 10K.
I hear you, but I see the JANA data entirely differently. The failure they highlight isn't a failure of the concentration philosophy itself. It's a failure of human execution.
How so?
The data shows that when firms mandate a higher active share, managers engage in what the industry calls diversification.
Oh, let's break down diversification mathematically because it's crucial here.
Please do.
So the JANA data shows that active equity managers attempt to run these concentrated portfolios, but they shoot themselves in the foot with their own trading activity. Imagine a manager has 5 brilliant, exhaustively researched ideas.
Okay.
But the fund's mandate requires them to hold 30 stocks to appear safe to their clients. So they go out and buy 25 mediocre companies just to fill the quota.
Right. Forced diversification.
Yeah. And when a stock drops, they add to losing positions to lower their average cost. When a stock rises, they trim their absolute best performers to lock in profits or balance their risk models.
Trimming the flowers and watering the weeds?
Exactly. Examined in aggregate over multiple years, this constant shuffling results in a heavy drag on performance. They artificially force a concentrated mandate without the underlying skill or the structural freedom to support it. Every time a manager adds their 30th or 40th best idea, it mathematically dilutes the returns of their top 5.
I agree with that specific mechanical critique. That is bad execution. But true concentration is not an arbitrary mandate handed down by a compliance department. True concentration is about finding highly specific superior business models and completely ignoring transient price quotes.
Like what kind of models?
Well, Nomad focused heavily on businesses utilizing scale economics shared.
Explain how that model actually works in practice.
It is a relentless feedback loop. These are companies that take the financial savings generated by their massive scale and immediately give those savings back to the customer. It constantly widens their competitive moat.
So like Costco.
Costco is the textbook example. As they get bigger, they negotiate cheaper prices from suppliers. Instead of keeping that extra margin as profit to impress Wall Street for a single quarter, they lower the price of goods for the consumer.
Which attracts more members.
Exactly. That attracts more Costco members, which gives them even more buying power with suppliers. They don't advertise, they don't offer quarterly earnings guidance to soothe analysts, they just steadily grow the moat.
It's a powerful model.
It is. And when you find a model like that, you concentrate your capital. You don't trim your winners just because a risk model tells you the position size is too large.
But buying Costco when everyone loves it is easy. Implementing this strategy requires stepping into highly controversial, highly uncomfortable territories when a company is heavily distressed.
Oh, it requires incredible fortitude. Consider Nomad's purchase of Xerox. When they bought it, a simple internet search for Xerox bankruptcy generated 640,000 hits.
Wow. So the market was pricing in total failure.
The broader market completely despised the company. It was the absolute definition of an anti-bubble, a stock priced for total devastation. But Nomad dug into the mechanics of the business.
And what did they find that the market missed?
They understood the residual value of the massive web of existing service contracts and the cash flow that was still coming in, despite the terrible headlines. So they bought it and held it.
That takes nerves of steel.
Think of the broader market like a frantic renter who moves apartments every 51 days. Because, by the way, that is the actual average holding period for a stock today. A renter only cares about the fresh paint, right? They don't care if the foundation is cracking.
And the concentrated investor?
Concentration is just acting like the landlord. You buy the building for the long-term cash flows. It's the logical arbitrage of patience rather than an excess of risk.
I don't buy the renter analogy.
Why not?
Because it assumes patience is a purely rational choice anyone can just deploy on command. Patience is inextricably linked to behavioral bias, which is exactly where concentration turns lethal.
Lethal is a strong word.
But it's true. What Munger casually dismisses as know-nothing investors actually includes highly trained, heavily resourced professionals who suffer from overstaying their positions. You mean?
Holding on to losers?
Yes. The research shows that when a concentrated thesis is factually wrong, when the business model is actually broken, the manager holds on, hoping for a turnaround, simply to avoid admitting defeat.
Well, ego is definitely a problem in finance.
A massive problem. And if you're diversified across 500 stocks and one goes bankrupt, you lose a fraction of a percent. If you are concentrated in 10 stocks and one goes to zero, you face a permanent capital loss that takes decades to recover from.
The risk of permanent capital loss is very real, I concede that, but it is mitigated if you understand the mechanics of the equity yield curve. This concept explains why long-term mispricing exists, for you to exploit in the first place.
You call it an equity yield curve, but to most of the market, that just looks like catching a falling knife. I mean, how are you mathematically separating the two?
It comes down to understanding institutional constraints. Institutional investors demand near-term certainty. Because of that 51-day average holding period, mutual fund managers and hedge funds cannot stomach short-term volatility or deferred gratification.
Because clients will fire them.
Exactly. If they miss their quarterly earnings benchmark, clients pull their money. This dynamic creates a steep yield curve for those willing to wait for long-term cash flows. Take the pharmaceutical company Schering-Plough in the early 2000s.
Oh, they faced a severe regulatory storm back then.
A massive one. They lost the patent on their blockbuster allergy drug Claritin, which meant generic competitors flooded the market. Revenues collapsed, and they were hit with a $500 million fine.
And a strict consent decree from the FDA, right, regarding manufacturing compliance.
Right. The stock dropped from $60 to $15. The institutional market, operating on short time frames, priced the company as an outright disaster.
Yeah, because the 29 analysts covering the stock couldn't look out 3 years. Only 6 even recommended it as a buy.
Because their jobs depended on what the stock did next month. They couldn't afford to wait for the manufacturing issues to be resolved. But Schering-Plough had a joint venture with Merck for a cholesterol drug combination.
Zetia and Zocor.
Yes. If you actually read the clinical data, looked at the trial phases, and mapped out the pipeline, that joint venture was expected to generate roughly $2 billion in operating profits several years out.
So the FDA compliance issues had nothing to do with the actual efficacy of the new drugs.
Nothing at all. The market heavily discounted those future cash flows because of the near-term regulatory noise and the extreme career risk of owning a plunging stock. That steep equity yield curve is your advantage.
If you have the stomach for it.
If you have the patience to wait out the transient noise and trust your analysis of the pipeline, the expected returns are massive. That's where you concentrate your capital.
The theory makes perfect sense on paper, but in practice, distinguishing between waiting out the equity yield curve and stubbornly holding on to a failing asset is nearly impossible for most humans.
It takes discipline.
You praise Nomad for their patience, but patience can look completely identical to denial until the final result is in. Look at Nomad's investments in Zimbabwe during the severe currency crisis and hyperinflation.
That was a unique geopolitical situation.
But it highlights the risk perfectly. They'd literally had to value their Zimbabwean holdings at zero on their balance sheet. The banking system stopped clearing trades entirely. The national stock exchange froze.
Temporarily, yes.
That is the ultimate cautionary tale of concentrated risk. When the macroeconomic environment turns against you, the loss isn't just a temporary paper drawdown. It's total.
Well, valuing an asset at zero for accounting purposes is very different from permanent capital destruction in reality. They marked it to zero because the country lacked a functioning, reliable pricing mechanism, not because the underlying physical businesses ceased to operate or generate local value.
But you can't access that value.
Eventually, things normalize. But you are hitting on the crux of the matter. Distinguishing between patience and denial requires an exhaustive, molecular-level understanding of business operations.
And that molecular-level understanding is exactly what is missing across the broader industry. We have to look at the structural reality of active management.
You're talking about the outflows.
Yes. In the year 2020 alone, U.S. active equity funds saw $241 billion in outflows. Money is fleeing active managers and pouring into passive index funds and ETFs.
It's a massive trend.
If concentration reliably worked, if active managers could simply identify these scale economy shared models and wait out the yield curve, they wouldn't be universally losing to passive indexes year after year.
The math is stubborn there.
Incredibly stubborn. Diversification via low-cost index funds is winning because active managers cannot consistently overcome their own behavioral limitations and fee structures.
I look at those massive outflows and attribute them to a completely different cause. The failure of the active management industry is not a failure of genuine concentration, it's a failure of the institutional imperative.
Meaning what exactly?
The industry is plagued by closet indexing.
Let's define closet indexing for a moment. This is when a manager charges high active fees, say 1 or 2% a year, but constructs a portfolio that just mimics the S&P 500.
Exactly. They buy Apple and Microsoft not because they have overwhelming conviction in the future cash flows, but simply because those companies make up a massive percentage of the benchmark index.
So they're playing it safe to keep their jobs.
They are terrified of career risk. If a manager strays too far from the index, builds a highly concentrated portfolio, and underperforms for just 2 quarters, they lose their job. The structure of compensation literally forces them to buy stocks they don't even like.
So the very structure of the investment industry actively prevents the patience required for concentration to work.
True high-conviction investing requires total structural independence from benchmark envy. You have to be willing to look entirely wrong for years.
Which is a tough sell for clients.
Let me give you another Nomad example that illustrates this independence perfectly. They held a substantial position in Weetabix, the UK cereal manufacturer.
Okay, the cereal brand.
Right. A private equity firm, Hicks Muse, came in and bid a premium to take the company private. It offered an immediate 20% profit on the shares.
Which sounds great.
Most institutional managers would take the pop, high-five their trading desk, lock in their annual bonus, and move on to the next quarter's target. Nomad voted against the buyout.
Wait, they turned down a guaranteed 20% gain?
They did. They recognized that the buyout price heavily discounted the true long-term compounding value of the business. They prioritized long-term wealth creation over booking a quick, optically pleasing gain.
They voted against it, but, they were a minority shareholder, so they ultimately lost that battle. And the company was sold anyway.
They did lose that specific battle, which taught them the vital lesson that sometimes you need to own enough of a company to influence the outcome. But the mindset is the critical takeaway here.
The willingness to ignore short-term wins?
Yes. Consider their investment in Black Arrow Group. This was a delisted, essentially illiquid business run by octogenarian founders. It was valued at zero on Nomad's books purely for regulatory reasons because it didn't trade on an active exchange.
Another accounting zero.
Right. Yet, it continued to operate perfectly well and even paid an unexpected 1-cent dividend. Nomad didn't care about the lack of market liquidity or the absence of a daily price quote on a screen. They only cared about the underlying economics of the business. The active management industry is failing today because it obsesses over the daily quote, not the underlying commercial reality.
I understand the romance of that narrative. It feels pure, almost heroic, But it requires an ecosystem of capital that is virtually impossible to maintain in the real world.
It is rare, I admit.
Nomad was able to operate that way only because they curated a highly unusual base of partners who signed on with the explicit promise not to pull their capital during drawdowns. They literally had zero partner turnover.
Which is incredible.
It is. But for the average market participant, or even the average institutional allocator managing pension money, that patient ecosystem simply does not exist. You cannot separate an investment strategy from the behavioral reality of the person holding the capital.
That's a fair point.
If the client panics and demands their money back during a 30% drawdown, your concentrated strategy is dead in the water, no matter how good the underlying businesses are.
I agree that the capital ecosystem is paramount. Without a patient capital base, a concentrated strategy will inevitably self-destruct during the first major bout of volatility. You have to align the duration of your capital with the duration of your investment thesis.
And that structural vulnerability is exactly why diversification remains the supreme rule for the vast majority of people. Broad diversification protects investors from their own psychology.
It is definitely the safer psychological route.
It mathematically guarantees that you will capture the wealth generated by the tiny handful of companies that drive almost all of the market's historical returns. If you try to pick the 10 winners and you miss Amazon or Costco, your concentrated portfolio will drastically underperform the baseline.
Yes, the penalty for being wrong is severe.
Diversification is not a crutch for the ignorant. It is a highly efficient, mathematically sound defense mechanism against a completely uncertain future.
We've covered a lot of ground today. This really boils down to whether you trust your ability to analyze a business or whether you trust the math of broad distribution.
Two very different paths.
Hyperconcentration demands a remarkably rare tolerance for volatility and a highly specific capital ecosystem. It requires ignoring transient price quotes, identifying exceptional business models, and executing with extreme, almost agonizing long-term inactivity.
And the mathematical safety of broad diversification simply cannot be ignored. The frequent, well-documented poor implementation of high-conviction strategies where managers diversify by adding terrible ideas just to fill a quota or overstaying failing positions out of pure stubbornness makes broad market exposure the most reliable approach for anyone lacking a pronounced, verifiable informational edge.
There is an enduring tension here between the theoretical rewards of absolute focus and the practical safety of spreading risk. The literature on behavioral asset allocation offers so much more to explore regarding how humans actually construct and manage portfolios when real money's on the line.
We are constantly fighting our own wiring. The math is easy. The psychology is the hard part.
Very true. We leave the conclusion to our listeners to evaluate against their own strategies. Which brings us back to our opening thought. When building a portfolio, you must decide what kind of structure you are trying to construct.
Exactly.
Are you engineering a massive, widespread suspension bridge with endless redundant cables, accepting that it will never reach the clouds but will definitely survive a Category 5 storm? Or are you building a narrow, towering spire, knowing it could pierce the sky, but fully aware of the total destruction if your single foundation cracks?